Okay, so hi guys, welcome back to the channel. So today I'll be reviewing a stock that when I tried to research this, there wasn't actually many articles about it. It doesn't have a lot of traction that I can see, especially in the stock news market. So this company is valued over $100 billion in market cap, and I have found almost no one talking about it, and the ones that I have, it was quite small analysis videos. So I would like to provide an in-depth analysis on this. I believe this company provides amazing growth potential as well. It's undervalued or very close to an entry price and gives a very high dividend as well. And more than this, it is also a Buffett stock that he has recently invested into across the last year or so. So let's go into this. So the company is AbbVie, and this is what I believe where the growth story comes from. So AbbVie has been successful in expanding labels of its cancer drug, which are Imbruvica and Venclexta, and it has an impressive late-stage pipeline, and the two immunology drugs, Skyrizi and Rinvoq, have been performing beyond expectations in 2020. And they have also recently acquired a company called Allergen, which has diversified AbbVie's revenue base into more therapeutic areas, enhancing its long-term growth potential. And the shares have also outperformed the industry this year so far. So more on this. So now that it's joined with Allergen, AbbVie has more than 120 pipeline programs, and many of which are seeking approval for new indications for its existing drug stable. So more of 60 of these 120 programs, which is half of them, are in mid or late clinical trial stages, suggesting that AbbVie has no shortage of candidates to bring into the market in the long term. Of particular promise is the company's first-line treatment for multiple myeloma implicity, and this drug successfully completes is if the drug successfully completes its ongoing phase 3 trials, it will be a position to grab market share from long entrenched competing products. So we can see that AbbVie has a lot of new, almost 120 different pipeline products, which is 120 different drugs that they're trying to bring into the market, and they've been testing a wide variety, and out of these, maybe 5 to 10 will be coming into the market with very strong potential. And some programs like this, like the treatment-resistant rheumatoid arthritis drug Rinvoq, which I've mentioned, has already approved for major indications, so it's reasonable to expect that the revenues will continue to ramp up with these new drugs that they're coming up with. So they have also been pursuing head-to-head comparison trials with competing products to almost compare and steal other companies' market share, which may soon start to pay off for its newest drug. So we can see that it has amazing growth potential. Maybe not amazing, but it has a stable and interesting growth potential that it can lead into in the future. So now that we've seen this, let's get to more the financial aspect of this company. So this company is a biopharmaceutical company, and it has a $184 billion market cap. And its biggest subsidiaries include Allergen, which it recently bought for $63 billion, Pharmacyclics, and Stemcentrx. And it has $60 billion in assets, and it's up 210% in the last 7 years when it split from its parent company, Abbott Laboratories. And these companies' revenues in the last 3 quarters have grown 30%, and it has a PE ratio of just 23 and has grown 123% in the last year. So just focus on this PE ratio of just 23. This basically means that you're getting all of this and you can make back your money 100% in 23 years. And these 23 years does not take into account future growth or where the company will be in the future. It's if the company stays on the same track it is right now for the next 23 years, you will make back your money. So this is not too above the S&P 500 or the whole market as a whole, and I think they have a PE ratio of 20. So you can see it's not that big of a difference. So now let's look at the financials of this company. So this has an earnings per share of $5.28, and it has been compounding 7% year on year. So this is not a 7% increase from the original. It's every year it's growing 7%. And it has a dividend of $4.21, and it has a dividend payout ratio of close to 85%, and it has a 5% dividend yield, putting it into the top 25% of dividend payers in the US market. So if you take into account its parent companies from which it split in 2013, the it is a dividend aristocrat because it has been increasing its dividend for the last 25 years. However, in the last 7 years, where it's been an individual company, it has been increasing its dividend as well. So it has a free cash flow of $15,327 million. So it has a lot of money to spare in the bank, and this is where it really comes to shine. It has a return on equity of 203% in the trailing 12 months. And you guys might think, oh, this is a one-off thing, but since 2013, its return on equity has been close to 100% or breaching the 100% mark. So basically, any money that you're investing into this company, it's giving more money back in a year. So that's really good. It has an interest coverage of 4.5 years. This is quite low. And once again, I'll touch on this because it has a debt to equity of 5.4. So although it's financially quite strong and it has a good story, has good placement, it's been in the right time at the right place, its debt to equity is extremely high. So basically, the debt it has is 5.5 times more than the money it currently has. So because of this, it may struggle to provide shareholders the same return on equity or the money that it's been getting in the future as well. And because of this, I would stay a little bit wary about this company, but the rest of this company is amazing. So just some financials continuation. Um, it is 27.7% undervalued. While this is not the same as PE ratio because this does take into account the future target prices and where the company will be in the next 5 to 10 years. But as of right now, the analysts as a whole say that this company is a buy and is 27.7% undervalued. And it has quite low volatility because, first of all, it's quite a large company, $184 billion market cap, and it's in the biopharmaceutical sector, which is not quite volatile. It's not that volatile and usually tends to stay as volatile as the market is. Has a PE ratio of 22.8, which is much better than its industry of 28.3, and it's slightly higher than the US market of 20, which I already mentioned. So although the price of $100 may seem a little bit expensive compared to a lot of other stocks, the PE ratio or the price to earnings ratio is not that far-fetched in terms of where the company is valued at right now. And it also lands in the top 25 dividend payers of the US market. So pharmaceutical companies generally commit significant portions of their profit to expanding portfolios of drugs, either through innovation or research or development or departments or through acquisitions. So the similar way that AbbVie had its allergen buy. So meanwhile, AbbVie's portfolio has been helped by some potential cancer drugs that are still in their early days, but it is still generating piles of cash that support the generous dividend that they give of 5%, while they still have so much money to invest in their growth potential as well, which I talked about earlier. So the operating cash flow of the first 9 months of 2020 grew 27% to $12 billion. So they have been stocking up slowly. They basically sacrificed a little bit of their growth potential to ride out this COVID wave. And the company is investing about 13% of their revenue in research and development, and all of this with a 200% return on equity. And the company has quoted that they think it will pay off with the increased approval of a dozen or so products or indications in the next 2 years. And all of this comes from their different pipeline system that they have. So the future price. So I have used Warren Buffett's method in how to calculating the price. So the earnings per share has grown from $2.64 in 2010 to $5.28 in 2020. So if you calculate this is 7% year-on-year compounding. So not 7% plus 7%. It's 7% every year. So if you take that and plug it into the future FPS, you see that close to 10 years from now, you get an earnings per share of $11. So if you take the current PE ratio, which is the most conservative method, if you take $11 and you multiply it by 23, you get a stock price of close to $240. So now use the financial calculator. So let's say you want a 10% compounding return on investment. You get an entry price of $96. So this $96 is actually not too far from the current stock price of $104. And if you look at a lot of what analysts expect, it has an entry price of $115. So you can see that the most conservative method, it is not too much different from the entry price. And for incorporating future expectations and company growth, it is much below the entry price that analysts suggest. So don't take this to account that the the $96 does not take into account the future extra growth, and this is the most conservative entry price. So if you want to have a more logical or future-based entry price, I think you should go off $115, and you can see the stock is trading at a significant discount. So the final evaluation. So ABBV ticks all the boxes when it comes to dividend greatness, and I conclude this is also seen by Warren Buffett, who had added this stock to Berkshire Hathaway's portfolio last quarter. The stock might bounce around as investors worry about the Humira sales. So that has been basically its biggest sales over the last 10 years, 10 or 20 years, making around 60% of its revenue. And this has slowly declined. So although the politics of the Humira drug or the pricing of it is a little bit shaky, the company still is able to keep the dividend payments growing despite these challenges, and investors can do well to make these shares a core holding of a dividend portfolio. So in the end, remember to do your own due diligence because I can't cover the entire analysis of a stock in a short video. But overall, I think that this stock is an amazing buy. It is backed so by Warren Buffett itself and provides good dividend growth and safety in this market time as well. Thank you.